Hello, everyone, and welcome to FAN Radio, your financial advisor news network. I'm Bud Kasper, President and CFO of LSA Portfolio Analytics. Joined with us today in studio, Bud Kasper. Bud, thanks for joining us.
Hey, pleasure to be here, Brad.
To get right to the point, the purpose of today's topic and conversation is what seems to be on the mind of every advisor, investor that's out there is the Fed going to actually have liftoff in September? And more importantly, how are we communicating that with clients and prospects as we're meeting with them to try to prepare for this type of an environment? So, Bud, my first question to you is, give us some insight. What's the language that you like to position with clients to help prepare them for this event?
Well, I'm really big on creating stories around events that are impacting our clients' portfolios because I think it gives a better sense of how things may play out into the future. So whether we're talking about stocks or bonds or commodities or whatever the case may be, I think we have to evolve or spin, if you will, stories that are relatable to our clients. So when it comes to the Federal Reserve, what we're telling people right now is this. We know that this economy is growing, but is it growing substantially enough to be able to sustain economic growth into the future? Because remember, and I tell clients this, the biggest thing that happened to us in 2014 occurred at midnight on October 31st, and that was the final installment, if you will, of quantitative easing. So quantitative easing is not there anymore. Therefore, we don't have what I refer to as artificial stimulation coming in from the Federal Reserve to help support the economy, and of course, the markets are related in that as well. One of the comments that I make to clients is this, is that because the Federal Reserve is so data dependent and will continue to be that way because that's the only thing they have left, I truly believe that the Federal Reserve knows that if they move by too much, if they move too soon or too often, then they'll throw this economy into a recession itself. And they are not going to do that. They will do everything possible, even on the outside or the outlier of perhaps even introducing another modest quantitative easing program if things were really to go off course. So with that in mind, you can actually go into Las Vegas and get a line on what the probabilities are of the Federal Reserve raising and when. Right now, the last one I saw, and this is a few weeks old, 60% chance that the Federal Reserve is going to move in September, a 30% chance it'll be in December, and a 10% chance it'll be in the first quarter of 2016. That said, if we get anything from a negative perspective in terms of the economy's growth, it would not surprise me if they were to postpone the higher percentage probability from September and actually have it occur in December. I think the Federal Reserve, Brad, really wants to make this increase. And the only reason I say that is because they want the monkey off their back. They have been talking about this for the longest period of time. Once it starts, and remember, in the history of the Federal Reserve, we've never had a one and done, whether it was an increase or a decrease in the Fed funds rate. So if they do go in and they move in September a quarter of a point, I wouldn't expect another increase, perhaps for another quarter, perhaps even longer, because they want to see what the effects are going to be in the marketplace and in the economy when they make that move.
And I think that's a great point. Talk to us a little bit about what you think that effect is going to be. There's a lot of thought out there that first rate hike has already been priced into the fixed income markets. Equities might see a short-term bump, but are fairly well positioned. Give us your thoughts on that.
Janet Yellen and company are not stupid. They know that they cannot excessively raise these rates. They know, as I stated before, that it could have detrimental effects to the economy and the implications to the markets are not good. However, I will say this, that because I believe that they are going to have to take a very gradual approach to the increase of interest rates, the impact for the bond market I don't think is going to be as severe as we would expect it to be if we looked at other prior rate hikes in Federal Reserve history. So we've been telling our clients that we don't believe that in the next 2 years that we will see the Fed funds rate greater than 2.5%, and it could be as high as 2% over that time frame. Now, that's a fairly lengthy period of time for the Federal Reserve to take this very gradualist approach. From the market's perspective, from the investor perspective, I think it is a calming type of a position that they're taking, because the stock market, I don't think, is going to be negatively impacted by the first move of the Federal Reserve. I think they'll digest it in. The question is, can you digest an increase in the Fed funds rate and still be able to meet your earnings expectations and the things that make stocks go up? And the answer is, I don't think stocks are going to be severely implicated. Even on the announcement, we might have some sort of a reaction, but I don't think it's anything fundamentally that should bother stocks at that time. Bonds, on the other hand, are going to start to be impacted. One of the phenomena that we saw last year occurred in the last 6 months, when we actually had total returns on bond mutual funds greater on June 30th than we did on December 31st. It wasn't necessarily because the bond market was falling during that particular period of time. It was a function of managers of mutual funds realizing that when they in fact make the announcement that they're going to raise rates, that there are going to be redemptions, shareholders are going to go and start dumping some of their shares, and of course mutual funds must do what? They must legally meet the requirements of redemptions. And so therefore, if they wait and sell bonds to raise cash to meet the redemption requests after the Federal Reserve has made a move, how stupid is that? Because now they're probably selling their bonds into a weaker market. So we saw headlines many times in the Wall Street Journal in the last 6 months of 2014 that said bond fund managers are massively creating cash in anticipation of the Fed's first move. So with that in mind, I think the bond fund managers have had plenty of time to prepare for this and to reposition their portfolios so that they in fact can weather the first increase from the Federal Reserve.
I enjoy your comments in terms of Vegas putting a line of when the Fed's going to actually have liftoff, and I bring that up only because I'm not sure if you saw this earlier this week. We posted a chart that said predicting rate changes, and it's really funny because as you look at the Federal Reserve, the 10-year, the interest rate, over time you have these little lines that come off of everybody's expectations, which is always seems to be we're going to be raising sooner rather than later. And this has been going on all the way back to 2009.
Mm-hmm.
I remember coming out of that difficult 2008, early 2009 period, and the biggest topic of conversation was, boy, the bonds are going to get slaughtered. Mm-hmm. We're going to have interest rates on the rise, but they haven't been accurate. And now we're sitting here again, and it's become such a production at this point that Vegas is putting a line in terms of when is this actually going to happen. So, if September doesn't happen, historically, we don't have a lot of liftoffs that happen in the month of June, trying not to disrupt year-end economic growth. And so does this, if September doesn't happen, is 2015 off the table?
Yes, it's a strong possibility that would be the case, because if something were to disrupt the move in September, it's strongly suggesting that there's a problem that the Federal Reserve FOMC committee sees, and therefore the postponement will call into question why. What are they seeing? Why aren't they taking action at this particular period of time? I can tell you this, though. Foreign entities do not want the Federal Reserve Bank to raise rates, because with the dollar being as strong as it is right now, and the fact that we are one of the few countries that is at least paying something to their government bondholders, it's going to make the interest rate position of the Federal Reserve much more attractive, and you will see, in my opinion, more foreign money that will come into treasuries at that time.
Wonderful. Bud, thanks for the time today. This has been incredibly insightful, and hopefully our listeners will get a lot out of this. To follow up, what we'd like to do is another show in the coming weeks talking about how do you calm the nerves of somebody coming in saying, I don't want bond mutual funds anymore. Maybe they read the Barron's article, Buy Bonds. If that wasn't the headline of the year, I don't know what is. Because now investors are thinking we need to be buying individual bonds. Next time, let's explore a little bit about how we can position the importance of even 40 Act mutual funds in the fixed income space, even in rising interest rates, and potentially explore some of the additional content that we've thrown out on the LSA website to help combat some of these big concerns. So with that said, Bud, thank you so much for your time today.
You're welcome.
Thank you, everyone, for joining us, and we'll look forward to our next production of FANN Radio, your financial advisor news network.